Good morning, everyone. Joe Mass here. It's July 18th of 2022. And I just wanted to give you a little update on what's driving the market and take a look at the yield curve and the recession. So as you've heard us discuss in the past, there's really kind of three things that drive the market. It's inflation, interest rates, as indicated by the yield curve, and corporate earnings, and then the Fed. And today I just want to take a look at the yield curve because we have an inversion that's been in the news, and the recession's been in the news. And I just want to tie those two together for you. Inverted yield curve and recession. So when you hear someone talk about an inverted yield curve, it's something that's usually associated with the predictor or the beginning of a potential recession. And so that's why we pay a lot of attention to it, and it's written about in the news. So a yield curve is just a graphical depiction of the U.S. Treasury curve. And so here you can see that we have on the bottom, we have the rates on a 1-month basis, 2-month rates, 3-month rates. Here's 2-year rates and 10-year rates, 30-year rates. And so what you'll see is that the 2-year rate at 3.18% is lower than the 10-year rate at 2.99. Okay, and so we can see that here. Here's your 2-year rate, here's your 10-year rate, and the short-term rate is higher than the long-term rate, and that's what's called an inversion. Now, the yield curve is flirted with inversion throughout the year. However, it has not stayed inverted for months or quarters at a time, and it hasn't been very steep, and it hasn't been across the yield curve. But we like to pay a lot of attention to that 2- and 10-year relationship, and then the New York Fed probability model, which we'll look at, really likes to look at the 3-month and the 10-year. And you'll notice that the 3-month, okay, is lower than the 10-year. So there's not an inversion between the 3 and 10, but there is an inversion between the 2 and 10. So on this chart, what we're looking at, again, is that as that 10-year falls below the 2-year, traders kind of get nervous. They're betting that the economy is slowing, as we're going to talk about GDP here in a moment, and we've talking about interest rates, or inflation, and so the economy may be slowing. In fact, I'll just talk about it right now. Last quarter there was a negative GDP, and this quarter, which will come out at the end of the month here, is expected to be down too. So technically, and I'm stealing my thunder from the next slide, we'll talk about a recession. So technically, based on the old definition of a recession, 2 down quarters of GDP, we're probably already there. But you can see here, the red lines are the recession periods, and then these circles are when the inversion has happened between the 2-year and the 10-year. So this might be a signal that the recession is here or about to come. And again, this is just one measure of a recession. So we've presented this slide before. What is a recession? Who declares a recession? Well, the recession is usually declared by the National Bureau of Economic Research, and their new definition, as you can read here on the screen, is it's defined as a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in GDP, gross domestic product, real income, employment, industrial production, and wholesale retail sales. And so this is the new definition. The old definition, again, was just 2 down quarters of GDP. So based under the old version, many of us are expecting that the GDP number, when it comes out at the end of July, will be negative and will technically be in a recession. Now, it's also interesting to point out that the NBER, a lot of the time, they don't declare a recession until it's already here or it's concluded. So it's really not necessarily a leading indicator. They're usually announcing the recession after it's occurred. Okay, so it's important to remember that. So looking at some of the different probability models out there, this one is from the Federal Reserve Bank of New York, and it uses the yield curve spread between the 10-year and the 3-month Treasury rates that we showed you earlier. And so you can see that although its rating is coming up, it's not getting to a level that has been calling for a recession in the past. Back here, you can see that the level got up over close to 40. We had a recession here, close to 40. We had that recession, and then back in the 2001, you see here, the reading got over that 40. So based on this model, we're not there yet. Looking at the 10-year and 3-month, the probability is still low. But looking at the 2 and 10-year, it looks like it could already be here, especially when you use the old definition of inflation of 2 quarters of down GDP. The probability from Bloomberg survey has a median probability of around 40% and a mean, or the average, of 44.6%. So again, you can see the distribution. And what these are the contributors from all the different banks and investment firms around the country that Bloomberg surveys, and they just take the average of that and look at the statistics from the median, the mean, the high, and the low. So again, it looks like from that model, there's almost a 45% chance of a recession. So it's interesting that based on which model you want to look at and which definition you want to use, a recession looks a little different. I think the important thing to remember is that we all can feel it, regardless if it's official or not. And of course, we've been repositioning the portfolios and encouraging you to have discussions with us about your allocations. There's two things you have to do. I won't show the slide again, but you're either more concerned with fighting geopolitical risks, or you're more concerned with fighting inflation. And for a lot of you, you're trying to hedge the middle and fight a little bit of inflation, but also fight a little bit of risk. So we can reposition the portfolios to help you do that. But anyway, I just wanted to give you a little information today based on some of the headline news and the recession and the inversion of the yield curve. So we hope you enjoyed it. And if you have any questions, please give us a call. Other than that, have a great weekend. Thank you so much.